I'm joined by my colleagues John Hodge and Dan Moynihan. John, do you mind saying a few words about yourself?
Sure, Alap. Thanks. My name's John Hodge. I am one of the managing partners of Miramar Global Executive Search. We're a boutique executive search firm, global firm with offices in London, Philadelphia, New York, Dubai, Zurich, Singapore, and Cape Town, South Africa. Heavy presence in industrials, broader manufacturing, med tech, industrial automation, all of which encompass there's a significant portion of private equity in our portfolio. And I'm excited to have the conversation today.
Dan?
Yeah, good afternoon, everybody. I'm Dan Moynihan. I'm a managing director here at Perlmeyer, specialize in helping PE portcos, privately held businesses, and publicly traded entities with their executive compensation issues. Have a real passion around long-term incentive designs and using equity to kind of motivate performance, especially in this PE portco world. So, again, I'm happy to be here and looking forward to the discussion today.
That's great, John and Dan. I really appreciate it. So, our goal today is to have all of you listening in walk away with some practical and experience-based insights. So, let's start with what's actually happening in today's talent market. So, John, what are you seeing today in terms of attracting senior talent into PE-backed portfolio companies?
Yeah, we're seeing strong interest, but highly selectivity, right? For example, we have recently we had a president candidate evaluating an opportunity that we were representing him on, and versus another private equity role. The other role was a 3.1, 3.5x multiple of invested capital. That was the story, but high leverage, unclear CapEx support. And the opportunity we represented him on was about a 2.2x case tied to operational improvement with committed investment, right? And he chose our opportunity, fortunately, because the path to value creation was clearer. So candidates are prioritizing sponsor behavior, board quality, and whether the value creation plan is actually achievable and something that they feel they can execute on.
And do you think that has anything to do with sort of what we're experiencing now with longer hold times at that point about really seeing the clarity of the value creation plan?
I do think that that's definitely one of the variables. I think the maturity and the continued acceleration of private equity into multiple industries and the asset class changing over the last 20, 25 years and coming downstream um, is just requiring the right talent, right? The right uh, seasoned, proven executives are just very selective, right? There's some naivete with people that are coming into this space for the first time. Um, if that helps answer that question for you.
Yeah, no, absolutely. So where do you most often see misalignment between sponsor expectations and candidate expectations?
Yeah, interesting. I think um, the expectations in terms of, you know, when a late stage, right, is typically where I see that. As an example, I you tend to see as that goes on in a process later in the stage because sometimes the role alignment changes. Uh, Oftentimes, in the midst of a process that a candidate is in, sometimes the remit changes
Oh,
and
that's interesting.
it creates and it's really kind of unbeknownst. It's a communication issue, right? And it creates some some trust issues, if that
Right. So,
gives
so
you
as
gives you a sense.
as information sort of being uncovered and such, it's sometimes sort of the expectations for the role and sort of what the remit ends up changing. That's really interesting because I've seen it firsthand, and this timing of things happening late in the process, and so I'm always very curious, like what in your view, what typically causes a search to break down when you are so late in the process? Because usually we're thinking it's pretty buttoned up already, but any sort of, indicators?
Yeah. I think what often happens, when the equity math, doesn't hold up to scrutiny. For instance, if a CFO candidate uh, might walk, after modeling the dilution, from a likely recap that's reduced the expected outcome by 40%. I mean, other places where it can break down, as I mentioned, is when the role evolves mid-process. So, for example, it might go from a transformation in the beginning, and the candidate is entering into a process thinking, he or she is going through a transformational uh, journey, while then it becomes a cost-cutting,
Uh,
exercise, like in the middle of it, which, um, and then the compensation doesn't get adjusted, and the expectations don't get adjusted. So again, that's another, um, that it's about trust, and it's about, an executive's um, ability, or at least what they feel is their ability to be able to execute, on a plan.
yeah, and I think it goes back to your earlier point, making sure you're matching the right candidate with the right opportunity.
Right.
Because it just may not be something that they were expecting to do, when they were expecting to do a transformation, and now it's sort of a cost cutting. I think it's an excellent point. And actually, that's a pretty good segue into shifting to how sponsors should structure compensation once they've identified the right leader. So, Dan, um, how should sponsors think about what market really is in a PE-backed company?
Yeah, great. And it's interesting because I think John brought up a few points that kind of dovetail pretty nicely into this. So, I think the first point is really, market for these jobs, is not what's going on in the public company market median space. Like you can't look at a set of similarly situated public companies and say, hey, the median comp is $1 million. It's the same here. It's really a blended construct. You really need to think about what's going on in other PE-backed organizations. What's really the role scope and the risk profile. And I think that's when I think about it, it's a real risk adjusted opportunity here. It's not a job. You've got the equity component, which carries a lot of uncertainty for many executives. So I think you need to think about the market, being an answer, not the answer. The answer for your organization really needs to be grounded in your investment thesis. Is this a turnaround opportunity or is it a growth play? What's the complexity of the business? And also kind of that time horizon to liquidity, and as we've seen extended holds, I think that changed a little bit of the dynamic of what's market around, compensation. But I think at the end of the day, people can come in with whatever answer they think is appropriate for their role and what their expectation is around kind of current cash and future compensation. And it's trying to find that right balance between the appropriate amount of cash to live, plus the future opportunity and the equity payday. And, really what we always say to our committees and senior leaders in these businesses is that, compensation's an answer. It's just a reference point for your judgment to then really apply based on your unique situation to, what's going on inside your four walls.
Yeah, let's dive a little bit deeper into sort of that market question because I recall years ago, it was very clear that market for PE-backed companies should be other PE-backed companies. But now, with sort of the significant increase in the number of companies that are sponsor-backed, is it wise to exclusively focus on PE-backed companies to sort of determine that market?
You
And how
know,
do you balance sort of if you're using public companies or other private companies, how do you balance that against the PE sponsored data?
yeah, I think you need a little bit of a blended look at all of it of, what's going on in similarly situated PEs, but what's going on in the public company space. Because I think to John's earlier point around scarcity of talent, especially in these middle market organizations, if you're trying to lure talent in that can really, get into your play, especially if it's a growth play and you want somebody who's been there, done that, and already knows how to take your, a business to the 500 million, billion, 2 billion, $5 billion zone, whatever the sponsor's thinking. Sometimes you really need to go into that public company marketplace. And we have seen kind of a collision of base and bonus getting much, much closer, in those jobs. It's really the equity component that's just very different, where, the equity play in a publicly traded company is slow and steady, wins the race with some nice, awards every year. Where in this marketplace, you're going to be thinking more around, one-time sign on with the potential for an occasional refresh or other. So I think you need to be mindful of that marketplace, but you can't be beholden to the public company markets. It has to be just kind of all in part of the solution.
No, that makes sense. And we're definitely going to spend some time talking about equity. But before we do that, let's to dive into a little bit about the other forms of compensation, the other elements of compensation. So what role should annual incentives play relative to equity?
Yeah. So I think, the annual incentive really needs to be there to support the business, be focused on those near-term milestones and really the execution of the day-to-day of the business. So, your salary is there for getting you in the door every day. The annual incentive is really going to be tied to those short-term, results in the business. And ideally, it should be a mix of financial, operational, and strategic. It can't just be go chase EBITDA all day, because that's, going to be the answer for this business. So we really try to make sure that you're thinking about your short-term incentive plan so that it's got components in there that really carry up to your, your value creation plan, so it will support the equity over time, but it also needs to be distinct enough so that, the operators have clear kind of view on what's expected of me in the short term for this business from operational excellence. And then how do we create that into long-term shareholder value and growth?
Yeah, no, I really like what you said there by the term execution, because it does seem to suggest that the bonus should drive execution because the equity creates alignment. So I think that's a
Mhm.
very important point. So and when you look at bonus programs and the metrics they use, my experience is that a majority are using EBITDA, and that's the sole metric. Is there
Yeah.
how do you feel about that? Is there a missed opportunity in terms of better alignment to the value creation plan?
So I think you need to first start with, is EBITDA the right metric? And at times in these plans with an overweighting towards EBITDA, people can make, mistakes in judgment around, the overweighting of EBITDA and chasing EBITDA. And so I think there's also the challenge of kind of goal setting around EBITDA. If it's too easy, you get a little bit of an entitlement mindset around it. If it's too high, you might, have some perception of unrealistic expectations and, potential for disengagement from the senior team. So, again, I think ideally, I'd really like to see an incentive plan that has some mix of operational and strategic in it, as well as just the financial of the EBITDA. And EBITDA can be the answer, but, sometimes, without, if you're not growing your revenue and just chasing EBITDA, it's a zero-sum game. It can work in a short term, but it's not going to work forever. So I think you need to be focused on, a couple of financial metrics, with top line growth and bottom line efficiency, as the two key ones, and then thinking strategically around, what are going to be some of those, internal operational strategic decisions, building blocks, administrative things that need to get done to really help the business grow in value over time.
Yeah, I'm definitely sort of starting to see a sort of a 20 to 30% weighting on operational metrics when
Yeah.
we sort of start thinking more about closely aligning to the value creation plan. You mentioned some mistakes already, over reliance on one metric, potentially too leveraged in bonus plan design. Any other common mistakes that you see you want to point out?
Yeah, I think again, if you're too heavily weighted on EBITDA, you can have a short-term focus on earnings, at the expense of kind of investments, so cutting, CapEx going forward and growth and or, sometimes also timing of decisions can be a challenge. Do we pull forward some revenue? Do we delay some spending, in the interest of trying to nail down, a short-term incentive? And I think that's why the totality of the compensation plan really needs to be accounted for and communicated pretty regularly. And that's why the linkage to the value creation or the MIP at the end of the day needs to be clear so that in an ideal world, you'd love for your operators to sometimes make a decision that could hurt their short-term incentive for the benefit of increasing, value to the business. And, it's trying to find that yin yang or that push pull, on those levers so that, your management team is kind of doing the right thing all the time, for the business and not being too mindful. And if you're overweighted in size on your bonus, it can have the same effect where, the people are saying my MIP or my equity might not pay out what I want, so I need to really hyper leverage my short-term cash to get the value out of this business and what I think it's owed to me.
Right, which then creates a vicious cycle because then that puts up even a further drag on the realization of that long-term value creation.
Correct.
So you definitely sometimes see that where the cash bonuses can have a detrimental impact on that long-term value creation. Is there any sort of rules of the road we should think about that with that? Like when do incentives start to work against long-term value creation?
I think if you have short-term plans where, kind of your multi-year value drivers are not, being recognized, and they don't necessarily need to be metrics in the plan, but things around integration, transformation, capability building, if you're not thinking about those things kind of in your day-to-day business, ultimately you might end up eroding, future value. So sometimes you have to spend now for the value later. And if you're not thinking about those key drivers that will really help your business in the future, it could be, a blocker to your future, equity value.
Yeah, that's so true. So, as promised, let's turn to focusing a little bit more on equity, given that most of our alignment comes directly in the form of equity. So, John, to you, what distinguishes a well-designed equity program from one that creates problems?
Yeah, the best programs show clear payout of 1.5x, 2x, 3x, uh, you know, MOIC with transparent dilution assumptions. Uh, for example, a tiered ratchet that increases management participation above that, like a 2.5x, can strongly align behavior. Poor designs include overly complex waterfall structures or hidden preference stacks that make it difficult for executives to understand what they can actually earn. I think about what Dan was talking about and the variations, in cash compensations, the focus on EBITDA, and the equity, and certainly the equity can level the playing field. And but the cycles of these private equity firms and depending on their historic track record of how long they're going to hold on to a company and what their exit philosophies are, it becomes very challenging, right? From a focus on EBITDA in the short term, because the valuations are obviously derived from that, and the time frame, whether it's a 3-year hold, a 5-year hold, a 7-year hold, a 9-year hold, like depending on how long they're holding, typically it's a 5 to 7, right?
Right.
So, um, but in terms of answering the question around equity, I think those thoughts around very clear expectations with the transparent dilution assumptions uh, are the best laid plans. They're the clearest for executives.
So, John, would it be fair to say that, for from a candidate's perspective, that an overly complex, equity program tends to be a bit problematic?
Absolutely, right. Executives, they often assume 2% equity equals 2% on exit value, of exit value. And when in reality, after preferred returns or debt pay down and dilution, I mean that exit value might actually be like zero point 0.8 or 1.2 of actual proceeds. So um, the maturity of this marketplace, the strong candidates now are really asking, for full cap table visibility and scenario modeling before signing, like the ones that are good. Um, and that's a difficult conversation to have with your sponsor, right? Because of NDAs and private issues. So, yeah, but I think that it's an ongoing kind of evolution.
Yeah, so what you're saying is that candidates, don't necessarily shy away from, sort of probing on those questions to get more of that transparency and clarity.
And the ones that are really clear and have had the success and have had scars and understood like maybe the mistakes that they made in terms of their due diligence and asking the right questions will make better decisions. Um, but when they, to Dan's point too, if they have clarity in what they're trying to accomplish, then they're going to be more likely to be invested in value creation, maybe taking a hit on the short term and more focused on that longer term value creation because they're going to benefit from that, and everybody benefits from that. So, um, the good candidates, are asking really good questions.
So speaking of complexity, Dan, how should sponsors think about MOIC-based hurdles, like single hurdles versus tiered structures?
Yeah, I think it's interesting because, when you start thinking about design, it's, a mix of design plus governance, right? So when you start thinking about the hurdle things, the single hurdle can be great if you have a really clear binary value creation objective that's, we're here, we want to get there, we know what we need to do, go get it. But, the risk is in those plans with a single hurdle is that you can get to a place where you're getting close and it creates some kind of cliff behavior where it's like, let's do all things possible to get us to the cliff. And then, it might be you're not really building the sustainable business on the back end. You're pushing towards to the hurdle. So I think, the tiered hurdle works much better and clearer as long as it shows an alignment of outcomes. And I think John mentioned this earlier that the candidates are looking for the 1.52, 2.53, assumption, and they can see in their scenario modeling what needs to happen so that I can get some, to get paid at the end of the day. I've been dealing with a lot of portcos and sponsors right now where suddenly, we're 7 years into the thing and we're doing a recap and we've brought in some new, investment and people are getting reset and it's, some hard feelings on, what they thought they were going to get versus what they're going to get now. So I think it's really important if you're going to do that tiered structure to think about, are these tiers meaningful and appropriate? And I've been starting to see a lot of push from the management teams around, a hurdle that might be a little bit lower than the sponsor expectation, right? In an effort to kind of get paid. Like, what do we need to do to get 50% vested, in this thing? So that, especially as these, if there's a view that it might not be a 2 to 4 year deal, it might be a 5 to 7 year deal. So people are looking for some vesting opportunity. But it comes back to sponsor economics and minimum threshold returns. So I think it's really a balancing act. But, to John's earlier point, simplicity is great, but, we don't want to go too simple because it can create, misaligned behavior if it's overly simple versus, too overly complex. I think we want to thread the needle and get right in the point in the middle where we've got kind of a plan that's simple enough to understand, rigorous enough to align behavior, and disciplined enough to, for the sponsor and management to defend it on both sides.
Yeah, definitely. I'm definitely seeing more tiered structures happening and frankly sort of moving away from the bucket approach and more interpolation that's
Hmm.
happening between the different MOIC hurdles. And I think it just continues to um, be the result of these longer hold periods as well as, the shifting sort of ever shifting macro environments that we have. So management teams are just and sponsors are just dealing with a lot more uncertainty, yeah, over the past few years than I think we have than we have in the past. So having that flexibility on driving to tiered hurdles seems to be a good solve against that, or at least a hedge. So Dan, and again to you, how do you manage dilution, refresh grants, and recaps while maintaining alignment?
Yeah, I think this is an area that feels a little more challenging of late. So, as an example, I'm working with a portco right now that had used options early on, and they're about to have a pretty significant tranche of their initial equity kind of expire underwater. And so the management team is kind of looking for, refresh grants right now around, hey, we're 9 years into this investment. I thought we'd be out, but now you want to, refresh me. And you also want to reset my vesting, for the future in an effort to keep the team around. But I think you have to go all the way back to the beginning of when you're looking at this investment and you're chatting with your sponsor around really setting the expectations of understanding, what is the future dilution risk in the business? What future capital needs might we need? We kind of know we might need in the short term, 12 to 24 months, but let's, try to project really if things don't go, according to time and speed, and then how the equity may have to evolve between, one-time grants to refresher grants to even changing the vehicles. So I think you have to think about that, and then, on dilution. I think dilution's okay if you're doing, value accretive things like M&A. People are kind of tolerant of the dilution, but I think it's when, there's a perception that you want more equity and it's diluting, the core, investment. So without any real clear value creation, in an M&A situation of buying and bolting on, it's easy. But so that's that. I think on refresh the challenge around refresh is, when, why, and really ultimately how. And I think you have to really be like very performance and situational, viewed on that to say, have people changed roles, changed responsibilities? Has our view of the market changed? Is our is the equity that they have, is the holding power of the equity they have not really doing it for us? And we need to kind of refresh them with some. And I think that's the importance of really setting the right pool up front and using an appropriate amount of the pool, but having enough dry powder to allow you to kind of flex with the time.
Yeah, no, absolutely. I mean, usually we do sort of a 80% deployment, 20% holdback, or if
Right.
there's significant hiring that's going to happen, maybe it's a 30% holdback. And then on the refresh grants, I think it is important to have some guardrails. If you are going to enter into a refresh program, what is the frequency of that? How much does the individual need to be vested in their initial allocation? And then what percent of maybe the initial allocation or of market does a refresh grant constitute? So I think that's just it's more and more of an emerging issue, given what's been happening in the marketplace, where companies are sort of going back to the well on the refresh. So, John, we've talked about equity in a good amount of detail, and then some of the complexity. How do candidates react to these structures in real negotiations? What matters most to them, do you think?
Yeah. I think like as I shared before, executives are assuming it, a 2% equity equals 2% at exit. So I think to Dan's point about and the discussion around refreshing, it's about executives will enter into these processes or in these businesses when they feel there's an opportunity for one for them to make a difference and two for them to create value and have an exit. And the longer that these exits go, the more important these refresh type of situations, really should present themselves because we're trying to keep the incentive moving. We're trying to keep the motivation. But the expectations up front, right? How long, what's my life cycle in this opportunity, right? And these are these are not the global 2000 enterprises, right? They're not, 10, 15-year runs. We're talking about 5-year runs, 7-year runs. So, and so, to your point, Paul, up so, a lot of extension of those timeframes from investment to exit. So I mean, I think as the more sophisticated leader enters these businesses and have more experiences, and there's a lot of people coming into private equity as executives that have never been in private equity, so they don't really understand it. So I think the transparency up front is really helpful. Um, because as we were just talking about dilution and debt pay down and preferred returns, right? That you go in with it, you thinking you're going to get 2%, but in reality, maybe you're getting 1%. Um, so I think the more transparent sponsors can be, the better, and that's hard, right? Because there's no guarantees, and I don't see the adoption across all. I mean, there's so many private equity firms now with particular niches. So that's my thought process around it.
Yeah, I mean, one of the things that think is that's sometimes misunderstood by executives when they're thinking about their equity participation is that the the equity that they get upon hire is usually, I know we talked about refreshes a bit, but the equity that you get upon hire is usually the only equity that you will receive. And it is meant to drive alignment between them and the sponsor. And so when the sponsor is able to exit, then that's the monetization event. Are there other, I mean, what do you think about that? And are there other sort of, quote unquote, misunderstandings that executives tend to bring to the table when it comes to equity?
Yes, I think in the conversations up front, what I see is I see that equity component up front, but then I see other vehicles like profit interest and carried interests, like upon execution of certain milestones. So year beginning of year two, beginning of year three, beginning of year, 4 of their tenure with these companies, there's opportunities there for whether it's a cash or additional equity. Um, yeah, so that's that's the trend that I'm seeing, that there is actually a little more equity opportunity in subsequent years based on performance. But
Hmm.
having
Well,
it
that's good.
spelled out, having that spelled out, and having some transparency around what that means, and then having it having it documented right in the negotiation process up front, that can be difficult.
And
A,
got it.
a lot, something, I get a lot of questions from management teams really just trying to understand, what vesting really means. Because a lot of times,
Right.
they're vested, but, it's a must be present to win at the deal on the back end. And sometimes the documentation is not, clear enough for, people are like, well, I'm vested in this. That means I have access to this. And it's like, well, you're vested, but there's no, liquidity until event, which is on page 14 of the document. So sometimes, there can be a little bit of a challenge, in the understanding. These are not simple documents, and sometimes the complexity can, really be a challenge around that.
Yeah, definitely. I would agree. I think the question of, if I left, can I walk away with value from my vested equity is something that comes up quite often.
Mhm.
And sometimes it's an eye-opening, revelation. So then, when we think about John had mentioned, multiple sort of like follow-on programs that are starting to, happen. And which again, when you go back 10 years ago, 15 years ago, that definitely was not the case. It How do you ensure these designs or multiple programs are aligned with the investment thesis and defensible from a governance standpoint?
Yeah, I mean, I think you hit the nail on the head by the key, words in there were the investment thesis. So it's like, let's start with the thesis. Let's not start with the pay levels. So let's say, hey, what are we really trying to achieve here? And then make sure we understand how value is going to be created, and is it growth? Is it margin expansion? Is it M&A? Are we deleveraging this thing? Where are we trying to go with it? And then ultimately, kind of step back and try to build your compensation plans, so kind of reinforce those specific levers that are in your investment thesis or your value creation plan, right? So that really helps. And I think, if you go back to the kind of the two elements of variable comp, short-term incentives, and equity, the short-term pieces you really want to make sure are really tied to execution, potentially milestone based. Let's go out and get some things done, and we're happy to pay for those now. But the equity really has to be, MOIC or value based at exit is really the thing. And, I recently had a situation with a client, just talking about other vehicles where it was a recapitalization and a debt holder became the equity holder. And, they were a little unsure of the management team. And, there were some pretty significant old multiples, in the plan, and kind of the marketplace had changed around this company. And I don't think they had kept up, with the times. And, the sponsor was really uncertain of the management team and not sure if they were really going to be the ones to take it forward. But, they were able to successfully negotiate kind of a phantom equity cash type plan at a lower multiple. So because they were afraid that the management was afraid that the sponsor was just going to say, oh, forget it, and just get out from underneath the burden of the organization. So, and the management teams didn't really, they were saying, what's our incentive to stick around if we think you might bail, on a valuation lower than what we are tied into. So I think it was a unique opportunity to try to align a management team with, some level of motivation to continue to drive the business forward, for them with the uncertainty of whether or not their sponsor was actually going to stay in it for the long haul for them to really, get the value from their VCP. So that was kind of an interesting thing. And I think, the other really important thing is around pressure testing, and John said it for his candidates. They're thinking about it. What does it look like? Can we model this across, the base plan, the upside plan, the downside plan? Let's really understand that we can feel good about what happens if we get there, partially get there, or really, knock the ball out of the park. And I think those are things that help kind of make sure you're aligned with your investment thesis and, the economics of it, makes sense.
Yeah, no, I recently came across a situation that I think synthesizes, both those points that, alignment around the investment thesis and pressure testing, in the sense that um, there was a management team that was put in place for a particular investment, and as things sort of started being uncovered, they realized that the MOIC hurdles were very outsized in comparison to what the business reality is. And the sponsor definitely wanted to stay in the investment. And so now there was conversation from the management team to come back with some sort of like retention award or such,
Mhm.
or possibly recalibrating the MOIC hurdles. So I think you start having y- y- those conversations when that alignment with the value creation plan or a reassessment of that value creation plan, gets buckles under the pressure of that or buckles under the pressure of that testing, and sometimes you do have to go back to the well and recalibrate those hurdles to ensure that you have the proper retention of the team that you need in place. So I mean, let's talk connect directly about how value is created in different investment strategies. So to John, to you, how early should sponsors start thinking about compensation in the deal process?
Yeah, I've seen this in a couple different iterations and timing very different across some of the sponsors that we work with. But best practices is pre-close alignment. For example, leading sponsors define the CEO, CFO equity bands and bonus structures during the confirmatory due diligence pre-close. This allows them to move quickly post-close and avoid losing top candidates to competitors who present, the competitors that present like a fully baked opportunity. Um, I think oftentimes these sponsors may have alignment on a deal They may know who they want to lead them, but they need to act, right? Because the competitive landscape for the talent for the really strong um, talent is fierce simply because of the maturity and the acceleration of private equity across different industries and different size. The what small cap used to be versus what small cap is today, right? From a deal size perspective. So I think you know pre-close is the best is best practices that I've seen.
No, that's extremely helpful. And Dan, sort of shifting gears a little bit, when you think about the compensation and how it should differ across the investment thesis, like turnaround, growth, buy, build, I mean, what things come to mind when you think about distinctions of those programs should have?
Yep. Yeah, I think they're all pretty unique in kind of the mix of pay and what you're trying to get there. And I think just, even before you get there, and to John's point, when you asked about when should the sponsor start thinking about comp, I think one of the most important things is sometimes people will deal with the compensation as a one-time decision rather than thinking about it something that may and need to evolve with the organizational timeline, structure, deal, et cetera. So I think that's just something to think about. But if we were to look at kind of, if we think about turnaround, oftentimes, you've got a lot of risk and uncertainty, and whether or not the equity is going to pay is, a greater risk than many other investments. So, we do see a little bit of a higher cash leverage, in some of those deals where management is saying, hey, the risk profile is really high, so I need some more cash, and I need some equity to make it work, but you might not get it as, it might not be as lucrative as, another buy and build or, growth play. But also with, incentives tied to things like operational stability and cost reductions and the things that you're thinking about in your turnaround to really get the business, on its feet and moving forward. And sometimes, the skill set of the turnaround, team is not the skill of the operating team, right? So you may be thinking about a shorter term play, for some people to come in, stabilize, get it fixed. Might just take a little bit more cash to get that done, and they may exit before there's a real exit in the business. In the growth mode, I think you really get a little bit more equity upside, tied because you're really going to be thinking about revenues. You're going to be thinking about how do we get our multiples, higher? How do we get a higher multiple at deal? Short term, you're going to be thinking about revenue growth and expansion, strategic milestones. I think you get a little bit less overweighted on cash and more, weighted into where executives are really buying into that future value creation for the business. The buy and build, I think, is a little bit different because it's a little more balanced. You have to have enough cash to manage the kind of the complexity of the situation, but the equity really needs to align with the aggregated, the value creation plan that you're really going for. So you'll end up seeing a lot more, integration, synergies, execution in the M&A pipeline around the short-term rewards, and the equity is going to be might have to get built a little bit different because there's going to be various entry and exit points for executives as you're buying and coming in and out of these businesses.
Yeah, definitely. I mean, I think that dilute in a buy and build, the question of dilution and what happens to the equity programs, and tends to be really top of mind.
Yeah, and
Um,
the evolving capital structure, right? Like what the cap table when you walked in the door is not going to be the cap table when you walk out. So I think you have to have a very, solid awareness of that. There's going to be some, there could potentially be some real dilutive activity along the way, but
and so how do you ensure these incentive structures actually reinforce key value drivers?
For me, it's thinking about let's think about short term and what can management really influence, right? While we'd like to believe we can influence the multiples in the market, we can't. They're getting driven by the deals that are happening around us. So let's get focused on things we can influence, give them the line of sight they need. Kind of going back to my earlier point about, some financial, operational, and strategic things in their short-term plan. And then also even on the valuation and the exits and all that, making sure that those, MOIC multiples are, challenging but attainable, right? You don't want to tell the $100 million business they need to be a $1 billion business to exit. If it's not really attainable, they'll start discounting that equity significantly. So I think those are the things, and trying to make sure, I think also in the short term, don't get people chasing 12 goals, find the two or three that really, four maybe, that really make a difference for the business that people can really focus on.
Yeah, and I think there's a tendency to sort of copy and paste from one investment to another, and even though the portcos might be quite different in their trajectory, so I think it's important to really sort of look at each one uniquely and tailor a compensation program. eh, by basing the incentives and the metrics associated with those metrics in some significant like correlation testing. Like what metrics are truly going to drive the value rather than just sort of borrowing a structure from another investment. It may be the right structure, but without doing that diligence, I think it becomes more important to customize rather than to copy and paste.
Well, and also no two leadership teams are created equal, right? I mean, sometimes you have a B team and sometimes you've got an A team, and you need to think about that in the context of your compensation planning as well.
And so, but we're sort of running close to the bottom of the hour here. So before we wrap up, let's touch on how sponsors can operationalize this effectively. So, to you, John, will things break down when search and compensation aren't aligned early?
Yeah. Well, I think when comp and the search have alignment early, and it's consistent through the process, I think that that's a recipe for success. But a typical breakdown, this is the search narrative highlights significant equity upside, but then leadership through a process introduce more conservative structures later in the process. So that reduces perceived value. This creates retrading. It erodes trust. So that alignment up front, right? The alignment up front and the consistency through a process um, will avoid these frictions. Yeah, and again, that's communication because you may have multiple stakeholders in this interview in a process. And to your point about cut and paste, every deal isn't the same, right? Some people might be trying to apply a cut and paste, while others are trying to be creative and think through um, other forms of compensation. So I think if it aligns early, and it stays consistent, then it'll generally lead to a higher probability of success.
And do you find that the retrading is one-sided? And what I mean by that is it coming from the sponsor? Is it coming from the candidate as they learn more about the company and the investment thesis? Where do you find that or is it coming from both? And it's just very situation specific.
Yeah, well, it depends. I think it probably comes more from candidates, right? But in reality, um, they get more information. Their diligence increases in terms of their visibility to what's really going on. They talk to more people in a process within the business or at the sponsor level that gives them more, information. They realize that maybe their risk is higher, the ability to execute and deliver on the plan is more difficult. Therefore, they have more information and they start trying to negotiate. And that generally doesn't lend itself to a good situation unless the sponsor and the leadership team are like really aligned that this executive is who they need. So, yeah, interesting.
So Dan, given these breakdowns, I mean, from your perspective, what does an effective coordinated approach look like when it comes to compensation?
Yeah, I think John hit on a lot of them, but I think from the sponsor side, it's making sure you got a clear view of your philosophy, a clear view of, what is your number? What are you willing to pay for this candidate? And I think where I see a challenge oftentimes is getting, extra excited about a potential candidate and then trying to structure some ad hoc equity deal with them that's kind of outside the framework of what you've historically been doing, just to either try to offset some ask from the candidate or to try to structure the deal in a unique way. So I think that's often a challenge. I think, if you can have a really predefined equity framework, it certainly helps. You don't want to suddenly be like, hey, we're doing half, performance and half our, RSUs, and then have a candidate come in and then, they want to do a co-investment, and you got six other things going on that you're suddenly breaking the kind of the framework that you've been using. And I think, the other one is just having some governance discipline, right? I mean, if you can really make sure you've got some good rationale behind that, you got board alignment, and you've got really good alignment between your search partner and your sponsor, I think it really helps make the deal just go down that much smoother because you've got, the scenario modeling in place, how how much equity you're willing to share, how much money you want to spend on the talent, and then driving the deal and get it done. So I think, if you can align those things and, always be tying back to your investment thesis, because, how you make money and, extract value is going to be critical to making sure you got the right exec in seat.
Oh, that's great. So while going to invite the audience to post any questions that they may have while they do that, since we have about 10 minutes left, John, to you, top two takeaways from what you're seeing today.
Yeah. Candidates are doing their diligence on sponsors as much as sponsors are doing diligence on them, and credibility wins. So that's number one. Number two, uh, equity must be both meaningful and achievable, right? Model it clearly, tie it directly to the value creation plan. I mean, they're the two biggest takeaways that I'm seeing.
Thanks. Dan, to you.
I think for me, again, I've said it a few times already, but, comp should really be a direct extension of the investment thesis. If you can't clearly link the pay outcomes to the value creation, and the MOIC, your plan design might need some work. And I think, ultimately, really, unless you're really in that, uh, rebuild mode in a company or restructuring, let equity do the heavy lifting. The cash supports the execution, but the equity is really going to get the alignment, tied to the outcome of the business at the end of the day.
Okay, great. And Dan, will stick with you. One thing to avoid from either the sponsor perspective or the candidate perspective.
I think don't design plans in isolation. So, be mindful of, other execs, other investments, to John's point, the due diligence is happening both ways. So you want to make sure that, if you guys have a way of doing things in your firm and you're going to try something new with a new investment, there's a high likelihood they already understand how you guys have structured other deals. So I think you want to just, make sure that you're not doing it in isolation. And again, that, your thesis has been pressure tested against the outcomes for the business.
Okay. John, for you.
I agree completely, Dan. Avoiding designing compensation in isolation of a deal model. Like that's it, right? For example, like setting aggressive MOIC hurdles without aligning management's influence over the key drivers will lead to disengagement and missed targets. So, 100%.
So, one question that came in is that during, from and John, just to you from a candidate's perspective, what besides the initial equity program, is it in the candidate's best interest to be talking about follow-on compensation programs in addition to, base salary and bonus at the point of sort of higher end negotiation? So should they be asking for, what other incentives might be, at play, when they're entertaining offers, or should that be something that, should happen later on?
I think an open conversation and transparent conversation around, I mean, in the beginning, of a process or upon hire, right? You have goals. You have a 1 year goal, 2 year goals, right? And executing on those goals and knowing what your compensation is based on that those successes is key. Now, beyond that, no one has a crystal ball, right? And you to a degree are have to prove yourself. So I think in the beginning you can align to if X, then Y. But if we do 2X, you know, are having some discussions around, what might be in addition to that. It's a difficult question though, because you have to prove yourself. And but the time to negotiate is up front, right? The best time to negotiate is before you accept an offer. So there's a balance there, and you have to walk a fine rope at times.
Right. And Dan, this question comes from more, I guess, more of a sponsor perspective. Is that again talking about the long hold, unexpected long hold? It, when is it time to start talking about, long-term cash incentives, either in the form of a retention program or a transaction program?
Yeah, I think it's when you've kind of reached the end of the discussion around I signed up for the 5 year plan and we're now at year 5 plus. I don't think you need to kind of get too far ahead of the curve, but you should start thinking about, and I don't know that cash is always the right answer. I think sometimes it's the answer. I think maybe it could be an opportunity for a refresh grant or something else to really, hone in and get that talent focused on. We understand the holds longer. Maybe it's a tweak to the cash compensation, but I don't necessarily think you have to immediately run out and say, let's do, an added transaction bonus in cash or an added, get me to X multiple, in the next year or two and pay some cash because it's just kind of a misalignment between, sponsor money and management money at the end of the day.
Okay. One other question came through. This is actually maybe pertains to both. Is that when the situation is that a refresh program is being considered, but when you look at the equity that's been spent to date, it's very outsized versus market. The management team seems to be the management team that should be in place, but the only way to sort of keep them in place is to go for, a larger sort of equity refresh. So Dan, any sort of counsel for this particular sponsor of what they should be thinking about?
Yeah, I mean, I think this is one of those times where you have to think about what are you willing to, spend on management, because there's two options here. One is, make up a number, we're 60 and management has 40. They can issue more grants, but they're only going to dilute their 40, not our 60.
Right.
Or we're going to dilute everybody, and I think it's easy if you're a single sponsor. It's a lot harder if you're, multiple people at the table trying to get alignment around that. So, I think the challenge is, how did you get so outsized at the beginning? And sometimes you have to pay for your past sins with some additional upside, but that might be an opportunity where cash could be the answer, right? And not, not equity.
Yeah. And John, from your perspective, like, what should the candidates sort of be in that negotiation, if you will? What should they be sort of focused on?
Yeah, I think as we talked about before, it's long-term value creation, what we're really trying to accomplish, and the thesis is still the same. Um, and they're the right management, if they are the right management team. But things change, right? Obviously, very dynamic, very to a degree. There's a lot of volatility, right? You do acquisitions and M&A, et cetera. So, um, but if the value creation is there and the opportunity, the leadership team is the right team, um, negotiating, to for for more incentive, I think it is the right path, right? More incentive on the upside, but the value creation and the exit valuation has to change, right? From what their original estimate was for the management team then to be able to negotiate for more.
No, that's so true. So thank you both for great discussion. It's clear from today's discussion that early coordination reduces execution reduces execution risk. And even though compensation is a capital allocation, we're dealing with people. So needs and wants need to be clearly understood and articulated. So thank you again, and thank you for everyone who has attended the session. Really appreciate it.
Thanks all. Bye.
See you, everybody. Thank
Bye.
you. See ya.